Your wealth deserves stability, expertise, security. Your wealth deserves LGT Crestone, private wealth with over a century of global heritage.
Hello and welcome to the Global View on this Friday. Well, US non-farm productivity increased at a 3.5% annualised rate between April and June, the highest since the third quarter of 2020. US Treasury yields initially rose on data showing initial jobless claims fell to 216,000 last week, the lowest since February. And the yield on the benchmark 10-year, but that ended slightly lower, in fact, at 4.26%, while the 2-year fell below 5%. New York Fed President John Williams says it's an open question whether monetary policy is restrictive enough to bring the economy back into balance, saying we've got policy in a good place, but we're going to need to continue to be data dependent. Well, markets are pricing in a 93% chance that the Fed will leave interest rates unchanged when it meets later this month, while the chances of another pause in November are at 53%. And signs of a resilient US economy saw the US dollar gain, pushing the yen to a 10-month low and driving the euro and sterling to their weakest levels in 3 months. China's yuan slid to a 16-year low against the greenback, and the Aussie dollar is slightly weaker at 63.8 US cents. Beijing's widening curbs on iPhone use by government staff is raising concerns among US lawmakers and fan fears that US tech companies heavily exposed to China could take a hit from rising geopolitical tensions. Apple, its stock fell again and in fact on track for its worst two-day decline since November after news that Beijing has told employees at some central government agencies in recent weeks to stop using their Apple mobile phones at work. And Apple supplier Qualcomm, one of the US companies with the largest Chinese presence, that tumbled nearly 7% to lead losses among the major tech firms. And lawmakers of both major US parties have been vocal in their concerns about national security risks allegedly created by China's products, pressuring the Biden administration to get even more aggressive with Beijing. All right, well, for a view on monetary policy expectations in the States and how they're influencing investment decisions, we're joined by Dave Sekera, Morningstar's US Chief Market Strategist. Dave, very good to catch up with you again. Thanks for joining us.
Oh, good morning, Andrew. Good to see you again.
Well, before we get into strategy, interested to get your observations as to where monetary policy is likely to go, given what we're seeing with the US economy at the moment.
Well, we think the Fed is done at this point. We don't think they're going to hike rates, any further for this monetary policy tightening cycle. In fact, we actually think the next move for the Fed is going to be to start lowering rates, probably as soon as the first quarter of next year. And that's really just predicated on two things. Even though the U.S. economy has been stronger than expected, we actually even boosted our third quarter GDP estimate up to 3.2%. But we do still expect that tight monetary policy, the highest interest rates that we've seen since the global financial crisis, reduced bank lending will all take their toll on the economy. So, while we're still in the no recession camp, we do think that starting in the fourth quarter this year, we're going to start seeing the economy start to slow. And in fact, we think that it's going to be a slowing rate of growth for 3 sequential quarters. So it really won't bottom out until the second quarter of 2024. We also think inflation, is going to continue to keep moderating over the course of this year and into next year. We're looking for inflation to get down to the Fed's target of 2% or even slightly below next year. So I think between a weakening economy and inflation coming down, that certainly gives the Fed the room that it would need then to start lowering rates beginning of next year.
So Dave, given that outlook, let's take a look then at equities and the strategy there, and just some observations as to where we've come from with stocks having pulled back there in August after we saw that strong gain, certainly the first half of the year. What are your expectations then in the next few months?
Yeah, that was really the first monthly decline we've had here in the States since February, slight pullback. excuse me, of 1.8%. But year to date, the Morningstar U.S. Market Index, that's our broadest measure of stocks here in the U.S. We're still up 17%. So this puts us at the camp where we still think the market is undervalued. Certainly not as much as it was at the beginning of the year, but compared to a composite of the over 700 stocks that we cover that trade on U.S. exchanges, it puts us at a 4% discount. Now, some of the interesting things that we did, see in August was we had a lot of notable valuation upgrades, among the stocks that we cover. In fact, the number of valuation upgrades essentially doubled the number of downgrades. A couple that I think were probably most important for investors would be Nvidia. Yeah, we brought our fair value up there to $480 a share. Oh, excuse me. So on Amazon, that was up 9.5% to $150 a share. And then on Chevron, we brought that one up 7% to $152 a share. Now, for investor positioning, we still like being overweight value stocks. Those still traded about a 13% discount to our fair values. On a relative value basis, I think you can underweight both core and growth stocks. And we also still like mid cap and small cap. That's where we see the best value there. Mid cap stocks trading at about 11% discount to fair value, and small caps still at a nice healthy 20% discount to fair value.
Historically, Dave, can you give us some context here as to where the US equity market is trading in terms of a discount to fair value?
So at that 4% level, we're probably not quite at that 50-50 level. So if we look back to the end of 2010 and we look at the full range of the market being overvalued or undervalued compared to our current fair value, I'd say about 40% of the time I think the market has been more undervalued. So again, I do think if you're a long-term investor, time in the market is usually more important than trying to time the market. So I'd still be fully invested at this point, even though I do think we could see some volatility coming up, end of October, beginning in November, once companies start reporting their third quarter earnings and giving guidance.
All right, so Dave, let's break it into sectors then. I mean, you have spoken there of tech. Where are you seeing that at the moment? Do you think it is still overvalued at this point?
It is, although less overvalued than what we had it marked at the end of last month. So we did have a decline, in tech stocks generally. Plus, we then, boosted our fair value on Nvidia. So at this point, we still think technology is overvalued. It's about a 4% premium, to fair value. It's the most overvalued sector, under our coverage right now. But I would say, looking at, the balance of stocks that we cover, there's probably an equal number of upgrades versus downgrades, over the course of August. And of course, then we had the Apple news out today, that China is expanding its iPhone ban to additional government and corporate entities. Now, I did talk to our equity analyst this morning on that. He said it's really hard to know the magnitude of that impact at this point. But we noted was there's a lot more talk about Huawei's new phone reportedly only uses Chinese components. So he thinks there might be an upcoming push in China, towards Huawei. Now, we think Apple is already overvalued. It's a 2-star rated stock, trades at a 20% premium to our fair value. So in this case, I think this just puts even more pressure on the stock.
Just further to that point, Dave, what are your concerns there with that potential further decoupling, if you like, between the US and China and the impact that is going to have on some of those exposed stocks?
Yeah, and this has been in the works, for a number of months now. A lot of positioning between, the Chinese government and the U.S. government. The U.S. government banning a lot of the, high-end, semiconductors and equipment chip sales, to China. So I think this is really just a continuation of kind of a little bit of a trade war on the tech side.
All right, elsewhere then, sector-wise, utilities, which I see that you say was actually the worst performing sector in August.
It was down about 6.25%, in August. And so that really puts the sector now getting into, kind of undervalued territory. I think it's a good time for investors really to start looking around and finding some of these downward beaten up stocks. So the sector is now at a 9% discount to fair value. It was a 2% discount last month. And to some degree, I think it was really just pushed down by a combination of two things. One, interest rates, still kind of creeping higher on average here in the United States. But then we also had a severe fire in Hawaii, and a lot of people are very concerned that Hawaiian Electric, might have been the cause of that fire. We actually dropped our fair value on that stock, pretty significantly in order to incorporate the legal liability for that. So I think the contagion from that also brought down the sector. But I do think there are some companies with some very good growth prospects. Two that I would highlight, energy would be one of our team's picks. It's a 4-star rated stock, trades at a 22% discount to our fair value, pays a 4.5% dividend yield, and American Electric Power AEP also about a 20% discount and a 4.1% dividend yield. So those would be two, I think, if investors are looking for something utility space, where I'd start.
All right, and I guess further on, just as far as energy is concerned, what's your view there? I mean, you did mention Chevron, but I guess also what you're looking at with the global oil price at the moment and likely trajectory, given demand, particularly going to the Northern Hemisphere winter, but also given those supply cuts that have been extended now by Russia and Saudi Arabia.
Yeah, and interestingly, energy was the sole winner, last month. It's the only sector that went up. I think is up about, 2%. So again, when I think about the energy sector, I think investors really need to make sure they estimate what oil prices are going to be throughout an entire business cycle. So here in the short term, we do agree with the market. There is enough supply cuts and yet still enough demand out there that's going to keep prices high. But throughout the entire cycle, we do think that oil prices will begin to subside, certainly over the next couple of years and later into the decade. And that's predicated on our forecasts for, supply and demand. So on the demand side, electric vehicles are going to continuously make up a larger percent of outstanding vehicles. In fact, by 2030, our team estimates that 2/3 of all new global auto production will be electrified. So again, that will put a damper on demand for gasoline. And on the supply side, we expect a lot of E&P companies will start shifting their capital allocation, back towards exploration. So what we've seen here in the U.S., a lot of oil companies for the past couple of years have been very focused on paying, profits to the shareholders, whether in form of dividends or repurchasing stock. I think that with oil prices as high as they are right now, they're going to start shifting back towards more exploration. Another name in the sector we like is APA. That's one of the few other, undervalued E&P names. It's a 4-star rated stock, trades at a 20% discount. That's a 3% yield. There's also just good momentum in that stock. I think that stock rose, 8% or so, after earnings. And considering our fair value there's, $55 a share, we do still think that one has further to run.
Dave, elsewhere in the commodities complex, what's your view on materials stocks? And once again, I guess from an Australian perspective, a lot of this is driven by what we're seeing in China at the moment.
Yeah, so basic materials was down, 3% last month. Now, what we're seeing here is a lot of these stocks, we think they just sold off, too much on, short-term weak results as compared to what our long-term valuations are. So, for example, Compass Minerals, I think that stock fell, by 20%. Yet our equity analyst, he held his fair value steady on that one. Scott's Miracle-Gro, another one fell like 19%. We reduced our fair value by 9%. We think it's looking attractive here. Another one I like is International Flavors and Fragrances. Yeah, that stock fell almost 17%. We only reduced our fair value by 7%. It's a lot of interesting opportunities that I think the market is overreacting in the short term. And of course, I think we've talked before, we still see, a lot of value in the lithium sector, looking for just long-term secular growth there. And I also see value in the specialty chemical sector. So I think the market has pushed those stocks down, too much in the short term on recession fears, but we think the valuations there for long-term investors that could ride out any volatility will look attractive over the long run.
Dave, we're almost out of time. Just to round it out, let's take a look at consumer defensive, what you're seeing there, and I guess given the prospects, certainly as far as US spending is concerned.
Yeah, so what we're seeing with a lot of the defensive companies, the margins have gotten squeezed. A lot of these companies just haven't been able to put through price increases, for their own products, fast enough in order to make up for their own cost increases. So the good news for investors, a lot of these stocks are starting to sell off. We're seeing a greater number of opportunities. So the sector itself, still pretty fully valued here, but a lot of individual stocks, have been getting hit relatively hard. The two I'd highlight here would be Kellogg and Kraft Heinz. Kellogg, a 4-star rated stock, trades at a 30% discount, and Kraft Heinz is now a 5-star rated stock, trades at a 40% discount and pays a 4.6% dividend yield.
Dave, terrific stuff. Great to get your strategy as usual. Thanks so much for joining us on Morningstar. All right, that is the global view for this Friday. We're expecting a fairly modest open, slightly higher when we begin in just moments. Stay with us. The open is just around the corner.